The U.S. Treasury is walking a financial tightrope, balancing the nation's $37 trillion debt with a strategy that hinges on short-term Treasury bills. But here's where it gets tricky. This approach could backfire if market conditions shift unexpectedly. Let's break it down. To manage the staggering interest costs, projected at $950 billion this year alone, the government has turned to T-bills as a cheaper financing option. Money market funds have been eager to buy these short-term securities, but for how much longer? The catch lies in the Federal Reserve's looming rate cut cycle. As investors anticipate lower overnight rates, demand for short-term T-bills is surging. Why? Because locking in a 3.85% return for 6 months now seems more attractive than risking future losses if the Fed slashes rates to combat inflation. But this creates a dilemma. If the Treasury floods the market with short-term debt, it may force a pivot to longer-term bonds, which come with higher yields and risk premiums. And this is the part most people miss. The Fed's repo facility, which keeps money markets liquid and banks well-funded, is already showing signs of strain. When funds pull capital through this program, it signals a lack of trust in overnight rates. If the facility dries up, liquidity could evaporate, leaving the Treasury with no choice but to issue more long-term debt. Critics argue this strategy is unsustainable. Should the Fed's rate cuts outpace inflation, investors might lose appetite for short-term paper entirely. What happens then? Will the Treasury be forced to pay sky-high yields to attract buyers? And here's a controversial twist. Some economists suggest the Fed should delay rate cuts to stabilize the Treasury's funding, even if it risks slowing economic growth. Others say the Treasury should diversify its debt portfolio now. Where do you stand? Drop your thoughts in the comments. Now, a quick note about the expert behind this analysis. Joe Brusuelas isn't just any economist. He's a global authority on mid-size companies. With over 2 decades of experience dissecting U.S. monetary policy, labor markets, and fiscal trends, Joe has advised Congress and shaped economic narratives for major media outlets. From co-founding Bloomberg's Economic Brief to earning a spot on Bloomberg's Best Bond Forecasters list in 2023, his insights are both sharp and actionable. As the chief economist to the middle market, he's dedicated to amplifying the voices of businesses that fuel the U.S. economy. His work at RSM, Bloomberg, and Moody's Analytics has made him a go-to expert for everything from inflation to global finance. But here's the real takeaway. In a world where debt and liquidity are intertwined, the stakes have never been higher. And that's a story worth following, no matter where you stand on the debate.